Right now, there's this huge disconnect happening in the financial world. You look at the headlines and it's all celebration, right? The S&P 500 is roaring, hitting brand new highs. But if you look just beneath that shiny surface, there's a storm gathering in the private markets, and that's the real engine room of the economy.
And that brings us to the big question we're tackling today. How can these two things be true at the same time? How is it possible for the public markets to be throwing a party while the private markets are bracing for a hurricane? It's a paradox, and honestly, it tells you a lot about how money and markets really work.
Okay, so here's our game plan. First, we're going to pull back the curtain on the S&P 500 and see why it might be giving us all a false sense of security. Then we'll dive into the Fed's massive $9 trillion U-turn and see how that's basically creating a great drain of money out of the system. We'll see how this is sparking a kind of hidden crisis in the private markets, but you'll want to stick around to the end because we're also going to look at how all this chaos might just be creating some very unique opportunities.
All right, let's start with that shiny surface, the S&P 500. We're all conditioned to see it as this ultimate scorecard for the economy's health. But what if its readings are being thrown off by a really powerful hidden force?
Well, this is the force. This is the engine behind the whole illusion. By 2021, a jaw-dropping $7.1 trillion was directly tied to tracking the S&P 500. Now get this, that number had doubled in just 3 years. Just try to picture a tidal wave of cash that legally has to buy the same 500 stocks, no matter what their price is.
So what happens when trillions of dollars just blindly flood into an index? You get something called the concentration effect. See, the S&P 500 is market cap weighted, which is just a fancy way of saying the bigger the company, the more money it gets. So most of that new cash automatically buys giants like Apple, Microsoft, and the rest of the so-called Magnificent Seven. This just blows up their value, making the whole index look incredibly strong, even if, say, 400 of the other companies in the index are treading water or even sinking. So here's the kicker. When you buy an S&P 500 index fund, you think you're being safe and diversified, but what you're really doing is making a very active bet that a handful of American mega-cap tech stocks are going to keep winning.
Okay, so passive investing is warping the public markets. But what's happening behind the scenes that's creating the real stress? To get that, we need to bring in the main character of this whole drama, the U.S. Federal Reserve, and the absolutely monumental shift in policy it's making right now.
For more than a decade, the Fed's go-to move was something called quantitative easing, or QE. You could think of it as a giant fire hose of cash aimed at the economy. The Fed would just digitally print money and use it to buy things like government bonds. This pushed a flood of cash, liquidity, into the whole financial system, which made interest rates super low and made it really cheap for everyone, from businesses to home buyers to borrow and spend.
But now, to kill inflation, the Fed is slamming it in reverse. It's a policy called quantitative tightening, or QT, and instead of pumping money in, they are aggressively pulling it out. The main way they do this is by just letting the bonds they bought expire. So the government pays the Fed back, and then that money, it just poof, it basically vanishes from the financial system.
This chart really lays it all out. QE was the stimulant, right? It was pumping liquidity into the system, making money cheap. QT is the exact opposite. It's like an ice bath, draining that liquidity to cool down an economy that got too hot. And when you drain liquidity, capital becomes scarce, and when something is scarce, it gets a lot more expensive.
I love this quote from the source material because it just perfectly captures how weird this whole process is. When the Fed does QT, that money isn't getting reused somewhere else. It is literally being removed from the system. It's like it gets sucked through a portal into another dimension. And this is so important to understand because it means there is simply less money out there to buy assets, to fund businesses, to do everything.
And the scale we're talking about here is just mind-boggling. At its peak, the Fed's balance sheet held almost $9 trillion in assets. That's $9 trillion of support that was basically acting as the floor for the entire market. And now, that floor is being gradually but relentlessly taken away.
So what happens when a $9 trillion safety net starts to disappear? Well, it stops being an abstract policy and starts becoming real-world pain. The process is called deleveraging, and it acts like a giant drain pulling money and confidence out of the economy.
So check this out, because it's a feedback loop that can get really ugly really fast. It starts small. Money gets tighter, so people and companies cut back on spending. That means someone else's income falls, just as their mortgage or their car payment is getting more expensive because of higher rates. All of a sudden, they don't look so creditworthy, so banks stop lending to them. Now they're in a jam, so they're forced to sell assets, stocks, real estate, whatever they can, just to make their payments. But when everyone sells at once, asset prices crash, which puts even more pressure on everyone else, and you can see how the whole thing just feeds on itself.
Here is the absolute best way to think about this. For the last 10 years or so, with QE and 0% interest rates, we were basically investing on the moon. There was no financial gravity. Asset prices could just float up to these unbelievable heights. QT is the process of turning the gravity back on. And we all know what happens when gravity gets turned back on. So where is this new gravity being felt the hardest? Well, that takes us to the real heart of the story, the private markets. This is where the liquidity crisis is happening, far away from the flashy headlines of the S&P 500.
Okay, first we got to get one key concept down: illiquidity. A liquid asset is something like a share of Apple stock. You can sell it and get cash in your account in seconds. An illiquid asset is something like an office building or a stake in a private startup. You can't just click a button to sell it. It could take months, maybe even years, to find a buyer and turn that asset into cash.
And this right here is where the crisis is brewing. We're looking at a nearly $2 trillion wall of maturity that's about to slam into commercial real estate and private debt. These were all loans that were made back between 2019 and 2021, when money was basically free. Now, they're all coming due, and they have to be refinanced at today's much, much higher interest rates. The huge problem is, with property values falling and banks getting scared, a lot of these projects just aren't going to qualify for a new loan.
And this is exactly why the private markets are so vulnerable right now. It's not just the refinancing. Their main ways of cashing out, going public in an IPO or getting bought by a bigger company, have completely dried up because capital is so tight. And then you have this other nasty problem called the denominator effect. Big investors like pension funds have these internal rules, like they can only have 20% of their money in private assets. Well, when the stock market falls the value of their public stocks, the denominator shrinks. Suddenly, their private stuff makes up more than 20% of their portfolio. So they're forced to sell their private holdings, even if they're good investments, just to get back in line with their own rules. And that creates a flood of sellers in a market that has almost no buyers.
This picture really shows the two different worlds we're talking about. On one hand, you've got the public markets, a constant flurry of buying and selling where prices are discovered every single second. But on the other hand, you have the private markets holding these massive, static, locked-up assets. There might be tremendous value trapped inside that office building, but in a crisis, you can't get to it. The value is completely frozen. That is the liquidity divide.
So, is this all just bad news? Doom and gloom? Well, not for everybody. You know the old saying, in chaos, there's opportunity. And that brings us to our last section, the hunt for what are called special situations, times when immense financial stress can create some once-in-a-generation bargains. And look, this isn't some new idea. The legendary Benjamin Graham, the father of value investing, wrote about this exact thing decades ago. He pointed to the era of defaulted railroad bonds, where absolute fortunes were made by savvy investors who knew how to pick through the wreckage during a panic. And he predicted that these kinds of opportunities, what he called special situations, would one day return. Well, it's starting to look like that day is getting pretty close. So here's the real key to finding value in this kind of mess. For a huge public company, a share of stock is worth whatever the market says it is. But for a smaller private company, there's a world of difference between the price of a small piece and the value of owning the entire business. When a credit crunch forces good companies to sell off assets at fire sale prices, this huge gap can open up between their panicked market price and their true long-term worth. For investors who are prepared, that gap is pure opportunity. This is where you hear about things like GP-led secondaries, or you see business development companies, BDCs, that let you invest in the debt of these struggling private companies. But I have to give a word of caution here. Most of the private deals offered to regular retail investors are victims of adverse selection, meaning they're the deals that all the big institutions have already looked at and passed on.
And so we'll end with this famous question from Warren Buffett. For a decade, a rising tide of easy money lifted every single boat, both the seaworthy ones and the leaky ones. Now that tide is finally going out, and we're all about to find out who built their business on a solid foundation and who was just floating along. Thanks for joining me for this explainer.